Is Verizon going to reverse this ugly technical trend? Is this stock worth buying considering it has a 4.89% dividend yield? We're going to talk about that today on the Investor Channel. What is going on, investors? My name is Colin, and I hope you guys are having a wonderful day. We're going to go through Verizon's Q3 numbers. We'll go through it essentially line by line as we go through their revenue, their profit. I'll help you understand these numbers. We got to look at cash flows as well. We'll take a look at the massive investment that Verizon made during the quarter and over the last 9 months to bolster their wireless capabilities and to generate more income in the future, particularly off their 5G technology. We'll talk about all that and more on today's show. Now, look, over the last year, this stock is down 8%. Year to date, it is down 10%. This stock, along with other stocks like AT&T, have been underperforming the broader market. And certainly when you look at tech stocks, which we review frequently here on the channel, this stock has been an absolute disaster. But after reporting earnings today, the stock is up 2%. And we'll talk about towards the end of the video as well. This stock is starting to look like it wants to reverse this ugly down channel that we've been in for like basically a year now. This stock peaked out over $61 and bottomed down closer to $51. And now we're starting to see a sign of reversal. Talk about that from a technical perspective as well. Now, the Q3 numbers did come in today. Revenue did miss by about $340 million. It came in at about $33 million or so. More importantly, I think what investors are looking at is the consensus for their adjusted EPS was $5.29. The company is now expecting, this is for the full year, between $5.35 and $5.40, and that is up from their prior guidance from $5.25 to $5.35. Now, the company also expects their wireless service revenue, which is primarily the whole business now. This company used to have media properties like Yahoo and other sorts of websites and online advertising. Well, they've divested most of that business. They're expecting their wireless service growth to be about 4%. The prior guidance was between 3.5 and 4%. So they're coming in at the top of that range, which when guidance happens, when management gives you a range, they're likely going to come in at that top range. If they don't come at that top range, boy, the stock tends to react negatively. Now, the other thing that I want to give you just really quickly is just a little bit of a valuation view into Verizon. Okay, here's a 5-year chart of a price to sales. Okay, not everybody looks at price to sales, and it's not the perfect ratio. And we don't always look at ratios here on the Investor Channel. But I like to look at sales because a sale is a sale virtually at any company, okay? And we see here at Verizon, we're bottoming out here at about 1.6 times sales. We bottomed out there back during when the virus hit and all the stocks basically crashed or had a major decline back in March of 2020. We bottomed out at 1.6 times sales and then rallied all the way to 2 times sales. Can we bottom out here at 1.6? We couple this with the technical data that we'll look at later. If we're bottoming from a technical perspective, we could be bottoming from a valuation perspective. Both of those things can line up and could give us a trigger and give us actually more confidence to buy a stock like this. Now, let's give ourselves even more confidence and look at the numbers over at the Verizon. Now, the operating revenues here, we've got our 3 months ended here, and then over here is our 9-month. Our 2 right-hand columns is essentially year over year on a 9-month. Since this is our third quarter, we've got 9-month view there. So we've got our service revenue here coming in at the top, $27.5 billion. That's basically flat from where we were a year ago. That's not necessarily a good thing, but also not necessarily a bad thing as well, okay? And we've also got a wireless equipment revenue. I'll talk about that more here in a second. That is up 30%. We'll see how that could potentially drive the service revenue here in the future. Now, the cost of this service revenue came in at $7.85 billion. That's actually lower than the year before. So while our service revenue was basically flat, our cost actually declined just fractionally, about 1.3%. That is a positive for investors. And you can see why companies like Verizon, AT&T, T-Mobile have to invest and want to invest a ton of money into spectrum. They have to borrow boatloads of money. We're talking hundreds of billions of dollars to acquire the spectrum from the United States government, build that out across the United States, and then start charging customers kind of on a monthly rebill. Look at the margins, okay, of $27 billion worth of revenue. It only, and I say only, these are really good margins, it only cost us 7.8 to facilitate that revenue. Now, the cost of the wireless equipment is essentially a loss leader, okay? We spent 5.6 to make this 5.3. So we're losing money there, but we're making it up on the back end when this company charges customers on a monthly basis. We've got selling general administrative expenses. That actually went down 11%. You love to see that. Okay, these are costs that just flow right out of the business. And the fact that they were able to drive steady revenue on that top line, drive down cost of service revenues or cost, and then selling and general administrative expenses also went down 11%. And then we've got depreciation and amortization. This is a non-cash charge. So I know it's written here on the financial statements and it looks like cash. This is not necessarily a cash charge. And we'll see more evidence of that when we get to cash flows, but that's also down 5%. So you bet you our total operating expenses basically came in flat, even though our wireless equipment costs were up about 30%. Everything else was down, and I like that. Okay, I don't necessarily mind that we pay more for this wireless equipment and that we had to pay a little bit more for it, and the cost of that cost us more, because we're going to make that up on the back end. We're going to make that up on this service revenue in future quarters, future months, and even potentially future years ahead. But when you drive down all these costs and then drive a fractional top line growth on that revenue side, well, look, your operating income is going to increase and increase 16%. That's solid growth, okay? You went from 7.7 billion up to this 8.9. Now, the other thing that you want to do is when you see growth like this is compare it on a longer time frame. Again, we're looking at 3 months ended here. Let's look at it from 9 months ended. Our operating income up 15% from 21.6 billion up to this 24.8. These are very, very, very positive signs for investors. Now, the other thing I want to do is, so we've got 9 months ended here. You pull down all the way through with Verizon. You don't always, you can do this with any company. I don't always do it because, look, income taxes change, interest rates change on the debt that Verizon has to pay and other companies have to pay. Interest rates, a hot topic here in the market recently. And so we pull down all the way to the bottom line. The bottom line is always represented, or usually represented, if the CFO is doing a good job, by 2 solid black lines. Okay, they actually have 2 because they have a non-controlling interest company. But we come down here to net income attributable to Verizon coming in at $4.21 per share. So Verizon earned $4.21 per share over the last 9 months. Now, the reason why I'm emphasizing this is we come to our dividend rate for the entire year. So this is for 12 months. Okay, I just showed you their EPS for 9 months. For 12 months, they're paying you $2.56 per share, and they are earning $4.21 per share. Yes, this is a very, very well covered dividend, despite what you might see out there in terms of their debt and their other types of businesses that they run. Very, very well covered dividend, at least over the last 9 months. It certainly is. Now, let's look at this from a balance sheet perspective. As I'll talk about here in a second, this company spent a boatload of money over the last 9 months on acquiring spectrum to bolster up their system and their services. We've got a 9-month view here on the balance sheet here. So we start in the end of December and we go to the most recent quarter here, and we've got cash and cash equivalents declining by about $12 billion. Yeah, that's a decline of $12 billion. That is a lot of cash flowing out of the business. Okay, you went from 22 billion down to this very close to $10 billion. Now, accounts receivable also flowing down. $2 billion. So you better believe our total current assets in the most recent 9 months has declined to $14 billion. That is a tremendous decline, especially when you're looking at those things. Now, it gets balanced out a little bit when you look at their wireless licenses went up $49 billion during the last 9 months. They invested $96 billion this time at last year or at the end of last year. And now you've got $145 billion worth of wireless licenses, at least that they can recognize here on the balance sheet. So our total assets actually went up $36 billion, nearly $37 billion. So we took cash and current assets out of the company, and then we invested it into these wireless assets. And then when this company is basically a pure play wireless company, you actually like that they're doing this. Okay. You like that they're not buying websites and they're not buying media companies that they really don't have any experience running. And now they're investing in their core business. I like what Verizon is doing, at least over the last 9 months. Now, it's going to look ugly from a debt perspective, okay? They didn't have the cash to bolster their wireless business like that. So they had to take out, that's $20 billion. $20 billion worth of more debt. Okay, look, at the end of this last year, you were at $123 billion worth of debt. Now you're at $143 billion worth of debt. So you got to be comfortable with a company like this. And if you understand that their business, are people really going to cut off their cell phones with Verizon? No, that's probably the last bill a lot of people will cut off, right? And can they switch to AT&T? Sure. Can they switch to T-Mobile? Can they switch to a Boost Mobile or whatever service provider? Sure. There's going to be constant churn and switching back and forth, but Verizon and AT&T and T-Mobile are going to dominate the vast majority of customers out there. Now, the last thing that we do, especially with a company that's investing like this and a company that has cash flows, we want to analyze it from a cash flow. So we come down here to the statement of cash flows. We've got this is a 9-month cash flow. They don't give you a 3-month cash flow, which is no big deal. We want to look at this from a kind of a full year perspective. And so we've got a year over year view on this cash flows. We pull down this net income, which has really been bolstered up over the last 9 months compared to the last 9 months. We came up to this $17.9 billion. That is $4.2 billion more than where we were in the previous period. Now, what I talked about earlier was this depreciation and amortization expense. This is a non-cash expense. Okay, so on the cash flows, we get to add this back in. Is this something that they're going to have to reinvest in the business at a future date? They're going to have to redo some of their service lines or some of their service equipment. Yeah, they're going to have to do that, but they basically pay for it up front. They depreciate it on the balance sheet almost like it's cash, but they don't actually have to pay to fix that equipment until it fully depreciates and breaks and new equipment has to be put up. But they have to recognize that from an accounting perspective. Well, on cash flows, we get to add that back in. So we get to add this $12 billion back in. We've got some other things that we get to add back in and subtract. That gets us net cash provided by our operating activities coming in at $31 billion. Last year, we're sitting at $32 billion. So basically flat, off a little bit. So that's why it's tricky to analyze Verizon. You can look at this net income number and EPS and certain valuation metrics like price to earnings might look really good with Verizon, because look, on an earnings basis, on a net income basis, which is earnings, it looks really good year over year. Okay, it's up $4 billion. That is a huge increase. Okay, you go from $13 billion up to $17 billion in just a year. That's a massive increase. So price to earnings is going to look really good over at Verizon and other types of valuations. That's why when I showed you a traditional valuation metric, I chose price to sales, because sales is a sale. It doesn't matter what year and what accounting perspective you're kind of looking at with Verizon. Now, as we work through cash flows, we see that it's basically flat year over year from a cash flow perspective. Okay, we would like to see cash flow starting to increase, and I tell you what, if cash flows start increasing at this company, well, the stock price would absolutely start reversing, because this is what most investors, especially sophisticated investors, are looking at the most when they're looking at Verizon. Now, here's the all important investing activities here. Okay, so we've got our capital expenditures, excluding the software. That's coming in basically flat, okay, a year over year on a 9-month basis. Here's our acquisition of the wireless license. Here's where you just absolutely obliterate your balance sheet and your cash flow statement. Take a look at this. Last year, we only spent $3.7 billion. Yeah, that's right. We spent $47 billion over the last months acquiring these wireless licenses. Okay, I think this was back in February or March that they did this. Look, you had positive cash flows in the last 9 months of $31 billion, and you just blew $47 billion. Yeah, $47 billion on acquiring these wireless license. So you better believe that this company spent a ton of money over the last 9 months. This is where the cash flowed out of the business. So I showed you the balance sheet earlier and then how we had $12 billion basically exit the company. Well, a lot of it got chewed up by this cash, okay? They borrowed some of the money. I'll show you that here in a second, but they couldn't borrow all of it, okay? So here's our net cash used in investing activities, $57 billion. So they had positive cash flows of $31 billion, but they spent $57 billion investing in the company. And again, with a company like Verizon, they invest this $57 billion. They don't, it's not like a product launch like Apple. They spend all this money to make the iPhone and they sell the vast majority of them probably in an 8 to 12 month period. Well, it's a little bit different with Verizon. They have to acquire these wireless licenses. They have to build out the network. They have to acquire the customer, and then they have to charge that customer a monthly fee, hopefully for them over a long period of time, maybe over the lifetime of that customer, and they recoup that money over a long period of time. That's just the nature of this business. Now, how do they finance this? Because look, you do this too many quarters in a row, and you absolutely stone cold go bankrupt. But you don't go bankrupt because you have a lot of bankers out there that understand Verizon's business model. They understand that they've only got 3 legitimate competitors, maybe 2 legitimate competitors here in the United States, and pretty much everybody has to have a cell phone and has to have cell service. So it's a fantastic business to be in, and a fantastic business to be in, especially when you have very little competition, okay? The government basically allows you to have, I think the proper term is a oligarchy or something like that, basically a monopoly with just a couple companies involved. So bankers are willing to throw money at this company to a certain degree, okay? And obviously they're making money from an interest rate perspective, and we see in the most recent quarter proceeds from long-term borrowings. Oh yeah, the banks just lent them $32 billion. Yeah, $32 billion. Okay, so we did pay some dividends, $7.8 billion. We had some other repayments of some assets. And so we get net cash provided by the financing activities. Even though we borrowed this $32 billion, we only ended up with about $13 billion in terms of net cash. That's why you had cash flow out of the business from that cash side of the business, exactly about $12 billion. All things being considered, when you understand the company and how their business operates, when you understand how the cash flows through the company, it looks ugly in a vacuum. This last 9 months looks really ugly. They burned through a ton of cash. They had to borrow a boatload of money. Okay, we're talking about $32 billion just in the last 9 months. This company has well over $140 billion worth of debt sitting on the balance sheet, but they have all these customers paying them money every month. And we saw the gross margins on that product, and they're actually quite good. Now, what also is looking good, in my opinion, is a reversal pattern that we've got going on in Verizon. I have these channels actually marked out. We reviewed this company probably 3 months ago. And so this company has been channeling downward ever since we've been covering it, really since last December, November, December. I mean, it's been basically a year of channeling down here, and we bottomed out here at about 51. Now, there should be some really hard resistance. Okay, this level that I have marked out here with this horizontal line at at $54, this was support, okay? And we're talking about a couple years of support. The stock would bounce off this $54 level, and sometimes it would bounce really hard. I mean, look at it back just last year, or even earlier this year. It bounced at 54 and bounced all the way up to 59. Now, we broke through it, okay? We broke through this and bottomed down here closer to $50 per share, okay? And so now I would look at that as an area of support. Now, on the way back up, this $54 is going to be resistance, okay? When it was acting as support and we were bouncing off it like a basketball, now we're going to hit our head against it, okay? It's like jumping up into a ceiling now, and we're going to bounce off here. So that is a critical level for me, okay? I'm going to watch Verizon. Are we going to come to 54, bounce, and then go down? Okay, that often can happen when you hit overhead resistance, is you bounce and go down. If that happens, and I think buying Verizon on the way back down, maybe somewhere down here at $52 per share, certainly $51, $50 per share, could be good, especially if you're looking for a stock in a dividend portfolio. Now, the other thing that we're looking for is a break above $54 per share. So we're looking for a candle, couple candles, probably in this case, above this. And then, yeah, we've actually broken out. So you could actually potentially trade this, like play this as a trade, okay? You could play the breakout above 54, because you break about above 54, you're coming to 55, you're coming to 56. I mean, it's all the way up, probably a dollar increments, all the way back up, okay? There will be some resistance on the way back up, but you could get this channel instead of a downward channel that we've had with Verizon. Well, I think one thing you could do is actually start an upward channel. But the first thing is first, you've got to get above $54 per share. You get above 54, I would buy, personally, I would buy that breakout. Now we get rejected here at 54 and we pull back to an area and then show areas of kind of flattening out. I think you could buy that area as well. Again, Verizon, absolute stone cold winner in a dividend portfolio. Is this the high flying growth stock like a Microsoft or a Facebook or an Apple? Absolutely not. I still think the vast majority of your portfolio should be in high growth, mega cap, okay? High growth is one thing, but I also want mega cap because they are showing the profits. They're doing share buybacks. I mean, virtually every FANG stock is doing a buyback. Some of them pay dividends. They are wildly profitable, and they're growing as fast or faster than even the highest flying stocks out there that are wildly overvalued. So focus on mega caps, but you want that dividend play as well, and I think Verizon can fit into that. Hopefully you guys enjoyed this video. We'll be back again soon with more. Good luck with your investments.